Is the Fed intentionally trying to crash the market, or are they just confused? This past week, we got really good news that inflation dropped in May to 4%. And that's because CPI has now officially fallen 11 consecutive months after peaking at 9.1% last June. But even after that good news came out, the Fed decided to do the right thing and hold rates steady, but led the market to believe that more interest rate hikes are coming later this year. And while the market likes to pay attention to what the Fed is saying, they really like to look at the dot plot, as that gives an indication of where each Fed member sees the Fed funds rate over the next couple of months, as well as over the next couple of years. And that's where things start to get a bit confusing. Because at the moment, the Fed's median view of the Fed funds rate at the end of 2023 is currently sitting at 5.6% versus 5.1% prediction this last March. And on top of that, their median view of the Fed funds rate at the end of 2025 is sitting at 3.4% versus their previous prediction of 3.1%, which if you're having a hard time following this, they're implying that they're likely going to hike at least 2 more times this year, but follow it by 100 basis points of cuts in 2024. So why would you continue to hike the Fed funds rate if you expect to cut just a year later? It makes absolutely no sense. As I've said before, the Fed is paying way too much attention to lagging data. As inflation was going up and out of control, the Fed was on the sideline saying, hey, it's all transitory, there's nothing to worry about. And that's primarily because they were paying attention to the wrong data instead of actually looking at what was happening in the economy at that time. And on the flip side of it, they still have this super hawkish stance that they're going to continue to hike the Fed funds rate because once again, they're giving too much credit to lagging data. And one of the main components that they're giving way too much attention to is the rent shelter inflation data, which is currently showing up at 8% year over year. But here's the thing, we know that home prices have more or less been flat over the last year. And while we know shelter has topped, it really hasn't shown up in the data yet because it's lagging. And that's why economists are saying that it's a near certainty that housing inflation will fall soon, because they know that as we get more CPI prints, the rent shelter inflation data will start to move towards zero, which will ultimately drive CPI lower. But here's the problem. That absolutely means nothing unless you can get the Fed on board. At the moment, you have 2 different Fed members putting absolutely crazy statements out there in the market. The first one is the Fed's Waller, saying that it's not clear that bank failures had a material effect on credit tightening. Well, I think anybody out there in the market knows that the bank failures actually had an impact on the market. For one, it drove treasuries higher, which in turn pushed interest rates higher. On top of that, it affected a lot of the local small community banks, like Silicon Valley Bank, for example. And where it has had an impact that we haven't yet seen is on the commercial sector of the market. So to sit here and say that the bank failures haven't had an impact on credit tightening is absolutely ludicrous. On top of that, you have Waller also saying that the U.S. economy is ripping along. I think most Americans would agree that the economy is not ripping along. Yes, there are some sectors of the market still doing well, but a lot of it has to do with all the money that was pumped into the economy. Once that money is gone, you're likely to see the economy stall further. And the reason that they're saying this is they're paying way too much attention to lagging data. Yes, we do have some things in the economy that are pointing to resilience, like retail sales rising again. And while retail sales represent about 1/3 of consumer spending, I think a lot of that money is still coming because things like student loans are still in forbearance and people still have money from the government bailout over the last couple of years. In fact, California was still giving money out up until about 6 months ago. So once the government backs themselves out of the situation, people have to go back and start making their student loan payments, on top of things like people's credit cards being higher because of the Fed hiking interest rates for 10 consecutive months. Those things will ultimately trickle down into consumer spending and likely a slower economy. And as we've discussed before, good news for the economy is actually bad news for things like interest rates, as well as the Fed changing their hawkish stance. But as you start to see things like unemployment rise, people get laid off from their jobs, that's likely to lead to a slower economy, the Fed becoming a little bit more dovish, in turn leading to more reasonable Fed policy going forward. Now, I want to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. It helps the YouTube algorithm push it out to more people like you. And with that said, also feel free to subscribe to the channel to stay updated on everything real estate related. With that said, the number of Americans filing for unemployment was sitting at 262,000 this past week, which is near the highest level that we've seen in almost 2 years, which in turn is showing that there might be some softness emerging in the US job market. And that's exactly why I feel like the Fed did the right thing by pausing at this time, more or less saying that they're going to pay attention to what's actually happening out there in the market. This is something I believe they should have done a couple of months ago. And that's primarily because the interest rate hikes that they've been doing take some time to actually sink in to the market. You know, the hike that they did back in May, that hasn't yet impacted the market. It takes a couple of months for that to truly have an impact. But here's one thing we do know. Month over month inflation is going to continue going down over the next couple of months. As you can see from this chart here, we still have one major month over month replacement coming next month, which will likely be the biggest drop that we've seen in over 1 year. If we assume next month follows the trend of this past month where we saw a 0.1% on month over month inflation, that means when we replace that 1.2% from last June, we're going to be sitting at an annual inflation rate of 3%, which I realize is still above the Fed's 2% target, but ultimately shows that we're headed in the right direction. And with that, we haven't even taken into effect the lagging shelter data. So once that shelter data actually comes down and reports what's happening in the market at the moment, there's a really good chance that we're sitting around the Fed's target of 2%. Now with that, I know a lot of people out there are saying inflation is coming down. I'm not seeing it in my pocketbook. Groceries are still really expensive. Gas is still really expensive. Everything is still really, really expensive out there in the market. Well, understand that even though inflation comes down, that doesn't necessarily mean prices are going to come down. Inflation is about price momentum. So you can still have high prices while having low inflation. So where are we seeing the biggest year-over-year changes in inflation? As you can see from this chart here, we're seeing it in fuel, we're seeing it in oil and gasoline, used cars, medical care, apparel, as well as food at home and electricity. But on the flip side, we're seeing things like transportation, food away from home, as well as shelter increase, which is causing those inflation numbers to stay high. And that's why some people out there like Larry Summers believes that the Fed might actually be driven by internal politics versus the data that's actually reporting out there in the market. Even with that said, there are also people out there that believes that the US inflation report suggests that the Fed rate pause will ultimately become a full stop as the economy continues to slow. So the real question is, how will that impact housing over the next couple of months to the next couple of years? What we've seen on top of the inflation data is all of this Fed talk going back and forth, which is ultimately creating volatility in the market. But until you get a unanimous message from the Fed, you're likely going to continue to have volatility in markets, which means interest rates are going to continue to go up and they're going to continue to go down. But here's the thing, as we've seen interest rates come off their recent highs, we've actually seen mortgage demand surge as applications to purchase a home increased 8% over the past week. But here's the thing, they're still down nearly 27% from a year ago. And while I personally do believe that inflation is going to continue to moderate and the Fed is likely going to back off this hawkish stance, because I do think data is going to report lower, which is ultimately going to show them that the economy is slowing. But even with that said, I don't know that you're going to see any major moves in interest rates, any major moves in inventory. So for the foreseeable future, you're likely to see a housing market very similar to the one that we've seen over the last couple of months. And the main reason for that is because you're not likely to see any big moves in interest rates. Until you start to see the spread normalize between the 10-year Treasury and the 30-year fixed, you're not likely to see interest rates come down significantly, which means you're going to see interest rates likely trade somewhere between the 6 and 7% range for the foreseeable future, which means slower buyer demand out there on top of the seasonality that we currently have in the market. It's summertime, which typically means less activity out there because people are on vacation, the kids are out of school, people are out doing things versus shopping for homes. In addition to that, I believe that you're going to see inventory peak over the next 6 to 7 weeks as we round out summer. Currently, nationwide inventory is sitting at 443,000 homes, which means if we stay at the current pace, we're likely to have less homes on the market than we did in 2022 and even 2021. And again, the reason you're not seeing inventory come to the market is because because nearly 92% of homeowners out there have an interest rate below 6%. And most Americans out there don't want to trade their 4% interest rate for a 6 or 7% rate, which in turn leads to less available homes on the market, which in turn leads to less home sales taking place, and in turn ultimately leads to a slowing housing market.